What if you could build real long-term wealth through real estate? We're talking a single-family rental, a commercial property, maybe eventually an entire portfolio, even if you have zero experience and honestly don't think you have the money to get started. In this video, I'm going to show you exactly how everyday people are breaking into real estate right now, the funding strategies that most beginners have no idea exist, and how to figure out which path actually makes sense for you. This is what Asset Empire is built on, and by the end of this video, you're going to know exactly where to start. Here's the thing. Most people who want to get into real estate hit the exact same wall. They know it builds wealth, they've heard the stories, but between not knowing how to fund a deal, not really understanding the difference between residential and commercial, and just having no clear starting point, they never actually do anything. They spend months watching videos and reading articles that either push one narrow strategy or just completely overwhelm them with information. That's honestly why Asset Empire exists. We're here to give you the financial foundation first, and that includes capital access strategies like business credit, commercial financing, and SBA loans that a lot of beginners don't even know are on the table. And then from there, we give you the education across every major asset class so you can actually choose the path that fits your goals. Whether that's a single-family rental, multifamily, self-storage, mobile home parks, commercial real estate, whatever makes sense for you. Because look, building an empire isn't one size fits all. It starts with getting the foundation right. All right, so in this video, I'm going to walk you through 6 steps to getting started in real estate investing. And look, by the time we're done here, you're going to have a real roadmap, not just vague advice, an actual path from where you are right now to owning your first investment property. Let's get into step 1. Step 1, build your financial foundation. So before you even think about looking at properties, there are 2 things you need to have in order: a down payment and a decent credit score. Now I know a lot of people hear that and immediately think they need to be wealthy to get started. You don't, but you do need to be prepared. For a standard investment property, most lenders are going to want somewhere between 15 and 20% down. On a $200,000 property, that's $30,000 to $40,000 of your own money, which that's real money. But here's something most beginners don't know. If you're willing to actually live in the property for at least a year, you can use an FHA loan and get in for as little as 3.5% down. And a lot of smart first-timers use exactly that strategy. They buy a small multifamily, a duplex, a triplex, live in one unit, let the rent from the other units basically pay the mortgage, and then move out after a year with a cash-flowing investment already up and running. It's one of the best moves a beginner can make. Now on the credit side of things, you really want to get your score above 700 before you start this process, and ideally above 740. And the reason that matters is simple. The higher your score, the lower your interest rate. Lower interest rate means lower monthly payments. Lower payments means more money left over every month. That's what we're after, so pay down your balances, sort out any errors on your credit report, keep up with your payments. Your credit score is genuinely one of the most powerful tools you have going into this. Step 2, understand how real estate actually builds wealth. Okay, so you might be sitting there thinking, all right, how does owning one property actually make me wealthy? Like, what's the actual mechanism here? And this is honestly where real estate gets interesting, because there are 4 separate ways it builds your net worth at the same time. Most investments have 1 or 2. Real estate has 4. The first one is cash flow. That's just the money left over every month after you've paid all your expenses. So if the rent coming in is $2,000 and your total expenses are $1,600, you're pocketing $400 a month. Every month, that's money working for you while you're not doing anything. Second is appreciation. Real estate historically goes up in value somewhere around 3 to 5% a year on average. On a $300,000 property, that's potentially $15,000 in added value every single year, just from holding it. Third is loan paydown. Every month that your tenant pays rent, a portion of that is going toward paying down your mortgage. So your equity, the difference between what the property is worth and what you owe, is growing every month without you spending another dollar of your own money. And the fourth one, which honestly doesn't get talked about enough, is tax benefits. Real estate investors have access to some seriously powerful deductions: mortgage interest, property taxes, insurance, repairs, all of it. But the big one is something called depreciation, where the IRS actually lets you write off the value of the building over time, even while the market value is going up. In a lot of cases, that one deduction alone can offset a huge chunk of your rental income, which means you keep a lot more of what you earn. So you've got cash flow, appreciation, loan paydown, and tax benefits all working at the same time. That's why real estate has created more millionaires than pretty much any other asset class in history. And actually, in step 3, I want to show you a move that most beginners skip, and it ends up costing them deals, so stick with me. Step 3, talk to a lender before you start looking. Here's the mistake I see over and over again with beginners. They start scrolling through Zillow, they find a property they love, they get emotionally attached to it, and then they go talk to a lender and find out they can't afford it. And from that point on, every other property they look at gets compared to the one they couldn't have. It's a miserable experience. Don't do it that way. Talk to a lender first. Walk them through your income, give them your credit score, and just get a rough idea of what you'd actually be approved for. At this stage, you don't even need them to run a hard inquiry on your credit yet. Just have the conversation and get a projected number. That one conversation tells you your real budget, saves you from wasting time on properties you can't buy, and puts you in a position to move quickly when the right deal shows up. And that last part matters more than people realize. Real estate moves fast. Good deals don't sit on the market for weeks waiting for you to figure out your finances. You need to be ready to go. So now you know your budget, but what kind of property should you actually be looking for? That's step 4. That's step 4. Choose the right type of property. So this is where Asset Empire's approach is a little different from most of what you'll find out there. Most channels will just tell you to buy a single-family home and call it a day. And look, that might genuinely be the right move for you, but it also might not be. It really comes down to your goals, your budget, and the direction you want to go. Single-family homes are the simplest place to start. They're straightforward to finance with a conventional loan, there's a wide pool of potential tenants, and when it comes time to sell, you're not just appealing to investors, you're appealing to anyone who wants to buy a home. Duplexes, triplexes, fourplexes, these give you something really powerful as a beginner, which is the ability to live in one unit while your tenants essentially pay your mortgage. Your own living costs drop, you're building equity, and you're getting your feet wet as a landlord all at the same time. It's one of the most efficient ways to get started. One thing I'd say to avoid early on, though, condos. HOA fees have a way of eating straight into your cash flow. The rules can seriously limit what renovations you're allowed to make, and the resale market tends to be narrower. Keep it simple to start. 1 to 4 units, conventional financing, in a safe area with good schools, a solid job market, and the kind of neighborhood where people actually want to live long term. And once you find something you're interested in, you need to know how to tell whether the numbers actually work. That's step 5, and it's where a lot of beginners get themselves into trouble. Step 5, run the numbers. Cash flow is everything. So how do you know if a property is actually a good deal? There's a formula for this, and it's not complicated. Start with the rental incomes. Go on Zillow, Redfin, Craigslist, and see what similar properties in that area are actually renting for right now. That's your income number. Then you subtract everything it costs you to own the property each month. Your mortgage payment, property taxes, insurance, and then a buffer for maintenance and vacancy. Because at some point, a tenant moves out or something breaks, and you need to be ready for that. Whatever's left after all of that is your cash flow. If that number is positive, the deal is worth looking at harder. If it's negative, walk away. I know that sounds harsh, but buying a cash flow negative property is probably the single most common expensive mistake new investors make. Don't be that person. Here's a real quick example. On a $300,000 property with 20% down, let's say your mortgage, taxes, insurance, and expense reserves come out to around $1,900 a month. If comparable rentals in that area are going for $2,400 a month, you're clearing $500 in cash flow every month. And on top of that, you've got loan paydown and appreciation happening at the same time. That's 3 of those 4 wealth generators we talked about firing simultaneously. Now, when you're out there looking at properties, lean toward ones that need cosmetic work. Old paint, an outdated kitchen, worn carpet. That stuff is relatively cheap to fix and can add a few $100s a month in rent. What you want to stay away from are structural issues. Roof replacements, foundation work, major electrical problems. Those costs have a way of spiraling, and they can wipe out your entire margin before you even get a tenant in the door. And I can't stress this enough. Location is everything. You cannot change where a property sits. Prioritize safe neighborhoods with good schools, decent parks, restaurants, a healthy job market, the kind of place that attracts good long-term tenants, because a great property in a bad location is still a bad investment. Step 6, get pre-approved, make your offer, and close. All right, so you found a property that passes the numbers test. Now you go back to your lender and get the full pre-approval letter. This is when you actually let them run the hard credit inquiry, verify your income, and issue the official approval. That letter is what makes your offer credible. It tells a seller you're serious and you can actually close. When you put in your offer, make sure it's contingent on inspections, non-negotiable. A good inspector is going to find things you never would have caught on your own. Water damage, roof issues, electrical problems, foundation concerns, and whatever they find, that becomes your second round of negotiation. If the inspection comes back with $10,000 worth of repairs needed, you go back to the seller and ask for a price reduction. Most sellers would rather work with you than lose the deal entirely. Once you've sorted out the inspection and landed on final terms, you move to closing. You sign the transfer documents, you pay closing costs, which typically run around 1% of the purchase price. And just like that, the property is yours. From there, you renovate if needed, get it listed for rent, and you start generating the income and equity that you came here for. And here's the thing. This is really just the beginning. The people who build serious wealth in real estate don't stop at one property. They hold it, let it appreciate, save the cash flow, and when they're ready, they go again. Do it enough times over enough years, and that first property compounds into something that can genuinely change your financial life. That's the asset empire approach. It's not one strategy, it's not one asset class. It's the foundation, the capital knowledge, and the guidance to build real estate wealth on your own terms. Whether that's single family, multifamily, commercial, or eventually all of the above. So look, you came into this video not really sure if real estate was something you could actually do. And now you've got the 6 steps. You understand how the money works, you know what to look for, and you know what to avoid. Most importantly, you know that there isn't one right path. There's the path that makes sense for your goals. That's what Asset Empire is here for. To give you the foundation, the capital strategies, and the real education to build wealth in real estate on your own terms. If you got value from this video, go ahead and subscribe to @JoinAssetEmpire. We've got a lot more coming that you're not going to want to miss.